Let's start here with market mechanics and auction foundations, or how markets actually move, because everything else in this course depends on this lesson being understood correctly and fully. And if this lesson doesn't fully click, then every tool, every confirmation, and every execution decision we make later will be distorted and very confusing. So we're going to have to strip this down to first principles and rebuild how you think about price from the ground up. Now, by the end of Module 2, I guarantee you will see and understand the markets in a whole new way. You'll be able to connect all the dots and you'll finally see the missing layer of the market beyond the candlesticks. Now, most traders are taught to think about markets through candlesticks, patterns, or maybe indicators or bias and narratives. And they're taught to believe that price moves because buyers are stronger than sellers, or because a candle might look aggressive, or because one of their patterns completed. But that framing is wrong. It's not slightly wrong, it's fundamentally wrong. Price does not move because of candles or indicators, and price doesn't move because there are more buyers than sellers even. Every transaction, without exception, has one buyer and one seller. So the idea that price moves because one side suddenly outnumbered the other does not make complete sense mechanically. Now, what actually moves price? What actually moves price is liquidity. More specifically, price moves when resting liquidity is consumed. That is the core truth of the auction model. This is also where a lot of trading education crosses the line from incomplete into misleading, and some are just all out lies for the sake of marketing. You'll hear a lot of educators and tons of SMC gurus out there and certain Discord communities confidently claim that candlesticks, price action, or SMC show you exactly how the market moves. And I know it sounds authoritative, it sounds complete, and it sells very well, but it's not the full truth. In fact, it's half the truth at best. Candlesticks do not show how the market moves. They show where price ended up after the interaction already happened. SMC is useful because they define where to pay attention, but they do not explain why price moved when it did or what mechanically allowed that move to happen. Again, this is why so many of you who are trading SMC alone are getting wrecked or don't know when to trust your entry. When someone claims that candles or SMC alone explain how markets move, they are selling you a narrative, not a mechanism. Now, here's the raw truth. Markets do not move because a candle closed a certain way. They move because liquidity was removed. And I'm going to keep saying this over and over again until it's cemented in your mind, because that mechanism does not exist inside a candle. It cannot be inferred from a pattern, and it cannot be explained by structure alone with any level of proof. Order flow is the most reduced mechanical layer of the market information that exists. There's nothing beneath it. No indicator, no model, no system. Everything else is derivative of this order flow layer. So once you understand that, a lot of trading hype and trading gurus become very easily to identify. You're able to see through their marketing. Confidence without mechanism is marketing, and conviction without evidence is storytelling. This course is not built on either. It's built on raw truth, raw market data that provides us proof without guessing or assuming. Now, let's get back on track. Markets operate as a continuous auction. At every price, there is resting liquidity or limit orders waiting to transact. These are not active decisions. They are offers to do business at a specific price. So when price is sitting still, it's because those resting orders are absorbing incoming activity. Price only moves when these resting orders are removed, either by being traded through or by being pulled. This is the first mental shift you need to make. Price is not animated by candles, and price is constrained and released by liquidity. Now, let's talk about participation. There are only two roles in any auction: aggressive participants and passive participants. Now, aggressive participants use market orders. They are the ones demanding immediate execution now. Passive participants use limit orders. They are offering liquidity at a price. Aggression is urgency, and passivity is control. Market orders do not move price by themselves. They only request movement. Whether price actually moves depends on whether there is liquidity available to absorb that aggression. Now, if aggression hits liquidity and that liquidity holds, price stalls. If aggression consumes that liquidity and nothing replaces it, price moves. That's it. There is no other mechanism. This is why high volume by itself means nothing. You can have enormous volume and no movement at all. You can also have very little volume and very rapid movement. So volume tells you that trading occurred. It doesn't tell you that price was allowed to move. What matters is where that volume interacts with liquidity. Another critical distinction here is urgency versus size. So large size does not automatically move price, and urgent size does not automatically move price either. Only unopposed urgency moves price. So if urgency meets sufficient resting liquidity, it is absorbed. And if urgency meets thin or withdrawn liquidity, price travels. This is why price often accelerates not when participation increases, but when liquidity disappears. And this is why breakouts often fell, not because traders were wrong, but because liquidity was still present blocking them. So when you look at price move, the correct question is never who won, were buyers stronger than sellers, or was that bullish or bearish? The correct question is what liquidity was removed to allow this movement to happen. This question alone will reframe how you read markets. So by the end of this lesson, you should be able to explain any price movement without referencing a candle pattern, an indicator, or a certain narrative or model. You should be able to describe price behavior in terms of where liquidity was available, where it was consumed, and where it was withdrawn. That is the auction. Everything else in this course builds on that understanding. So, in the next lesson, we're going to formalize the two sides of the interactions by separating market orders from limit orders, fuel versus control, so you can clearly identify who is acting, who is waiting, and why that distinction matters.